Hi there, this is Michael Kramer of Mach Capital. Today is Tuesday, June 18th. It is around 8 p.m. New York time. So just as a quick reminder, U.S. markets are closed on June 19th here in the U.S. They'll reopen again for trading on the 20th. And the economic data really for the rest of this week is going to be fairly light in the U.S. You're basically going to be looking at initial jobless claims. We're going to be watching these closely because they have been moving up the last couple of weeks, and we're going to want to watch continuing claims very closely because, again, these have been moving up the last couple of weeks too. So, again, they're not alarming numbers, but again, it's the rate of change and the changing and the trends that really matter the most. And then, of course, on Friday, we're going to be getting S&P Global, U.S. Manufacturing Services, and Composite preliminaries for June. These have been diverging from the ISM manufacturing and services data we've been getting. These have been much stronger than those data points. So it will be interesting to see what they have to say about the state of the U.S. economy for the month of June. In the UK, we're going to have still CPI coming in on Wednesday, the 19th. You're also going to obviously have the Bank of England rate decision on you'll also have the Bank of England rate decision on Thursday. Right now, markets are looking for no change in rates. When we look at the forecast, you can see markets sort of pricing in right now the potential for the first rate cut coming in September with about 85% odds. And then the first full rate cut is fully priced in for November. So markets are sort of split on September or November being the first rate cut. We're going to be paying a lot of attention to see what the Bank of England has to say about the potential path for those cuts and maybe how many we can expect, because you can see by May of 2025 markets expecting at least 3 full rate cuts by then. And so that really will take us and start us off with the FTSE. FTSE has been coming under a little bit of pressure the last couple of weeks. It shouldn't be completely surprising given that we talk about the relationship between the FTSE and copper prices. So we have seen copper prices coming down, and we'll talk about copper in a few minutes. So again, this is largely what we've been seeing with this relationship. Again, what we're seeing also is pretty much a straight trend line down at this point, with support coming up pretty soon, right around this 81.06 area. And so we'll have to keep an eye out for that. Obviously, if this breaks, that's going to break this major uptrend. And that's going to potentially lead to a further drop to around 8,012, with the potential even to go all the way back to 78.20. Clearly, a break higher above this downtrend line would certainly open the door back to 82.90 to 8,300, with the potential, obviously, to return to the highs. I mean, certainly when we look at the FTSE, it's not oversold from a Bollinger Band or from an RSI perspective. Right now, it's been kind of trading right along that lower Bollinger Band. So we're going to want to pay a lot of attention to this. Momentum is really sort of neutral to lower at this point, though. You can clearly see with the 20-day moving average rolling over and the RSI clearly trending down. When we move over to the DAX had a pretty rough week last week. It's been trying to recover a little bit, although it hasn't really been very successful. We can see that the DAX basically broke what I would say is a pretty important downtrend. And more importantly, is it came back to and tested that trend line and wasn't successful in breaking back above it. So I think for right now, again, on the DAX, 18,240 region. So right now for the DAX, I would be watching this 18,350 area. If we can get back above this region, then I think you return to around 18,680. But again, what we're seeing right now in the DAX, clearly a loss of momentum with the RSI clearly fading. Although you did reach oversold levels on the Bollinger Band, so we're coming back in those bands. So at this point, this looks a lot like potential just a pause in the selling, and not necessarily a reversal in trend of the selling. Clearly, if we get back above some of these levels in here, that changes the story. But I think for right now, you have to favor the move down to 17,885, which is where your support level is, and potentially a test of 17,720 with that, with a break of this level really opening the door to much more significant drops, potentially all the way back to this gap area and here around 17,180 or so. When we move over to the euro has finally broken the uptrend that was in place. When you take a closer look at the euro on the 1 hour charts, you could also begin to say that the euro has maybe what looks like some bearish tendencies to it, with the potential for a bear flag to have been formed in the euro, suggesting that the next move is perhaps lower, and perhaps we're finally going to get that test of this 106 region that we've been talking about potentially taking place now for a really long time. That's finally starting to looks like it may be starting to pay off. In the meantime, you're going to want to watch this trend line, because clearly if we get above this trend line again, or this breaks, that's going to obviously change it and potentially lead to a retest of this 109 region, and to see basically whether or not this breakdown was valid or not. So again, two potential paths. I still think the path is lower towards this 106, but you have to watch for upside here. Clearly, with the Bank of England rate decision, we continue to consolidate. We're not really seeing much of a major change in trend. You can see we still have this sideways symmetrical triangle. We already have, I would say, 3 touch points on the top of this, which really sort of gives us a sense that I would favoring a potential third touch point at this region here. So around this 124 area. The reason why I'm thinking that at this point, we've been consolidating at this 128 area really since the end of May already, so going on about 2.5 weeks or so. We tested this region very heavily back here in January. The pound just for some reason cannot get beyond this 128 area, and at this point it kind of gives us a sense that and we're already seeing it now test support at this 126 region. So I think at this point, again, dollar strengthening still seems to make sense against the euro, and it is quite possible, depending on how the CPI data comes out, if it should miss, it could lead to the BOE perhaps being a little bit more dovish than what the markets are expecting, and that could lead to the pound further weakening. Because it seems like at this point the central banks, the Fed still seems like the most hawkish of the central banks. It seems like the BOE is likely to cut rates before the Fed, and it seems like the BOE is more likely to cut rates more than the Fed. So that's just, again, sort of leaning to this idea that you're likely to see the pound weakening versus the dollar. When we move over to U.S. indices, they've been sort of controlled by NVIDIA. I thought this was interesting, just to point out, is that you have what looks like a really nice ABC type pattern. Now, again, I'm just pointing out this is not because I'm trying to create Elliott wave here. I'm using the ABC as reference points, right, to give you a sense of where I'm measuring from. You have this low here, this high here, this low here, and this high here, and it really made for an interesting spot because we exactly hit the 100% extension for the NASDAQ, and it seems like an appropriate region, I guess, if you were to try to call for a market top. This would be like an appropriate region where you would think that the NASDAQ could potentially top around this 100% extension area. Now, saying that you think that there could be a potential top is obviously not the same as saying one should be short the market, because obviously this is a very difficult market to be short. But it is saying that perhaps we should be a little bit more careful with how we're thinking about the market than we would otherwise be. The other fact is that you have the NASDAQ basically trading above the upper Bollinger Band with an RSI that's around 81. So you have these very overbought conditions also presently in the NASDAQ. And it's not to say that the NASDAQ can't continue to rise outside of the Bollinger Band. It certainly can. It has done that plenty of times in the past. But it's the condition of having both the NASDAQ above the upper Bollinger Band and the RSI above 80, which really gives you a sense that this market is very overextended. So if there is going to be an area where you sort of think about where you could see a potential pullback, this certainly has the conditions for such, and it certainly has the there could be from a Fibonacci type standpoint for that to be the case. Additionally, we have this giant rising wedge that's present in the NASDAQ. So there are certainly conditions, there are certainly patterns that are bearish in nature, which suggests the NASDAQ is sort of in a spot where you could potentially see some sort of pullback of some sort of size taking place in this market. When you look at the S&P, these conditions, you don't have the same sort of mathematical Fibonacci relationship. Clearly, the 100% extension was left behind at 5,200, and the 1.618% extension is up at 5,900. But I guess if you want to really get cute with your Fibonacci's, you could find that the S&P is approaching the 1.272 Fibonacci extension level. Again, if you're trying to get cute with it. So at least from that standpoint, it doesn't really have the same sort of characteristics from a mathematical Fibonacci type standpoint, but certainly it does have present in it the rising wedge pattern, which you can clearly see I have drawn out with these red lines. You can also see that when we look at the Bollinger Bands, we are also trading above the upper Bollinger Band now, really for a couple of days in a row. You also have an RSI above 70 at 77. So again, you have these two conditions where the S&P 500 is trading above the upper Bollinger Band, and you have an RSI that's above 70, which is suggestive of potential for a pullback. You saw something similar at the end of 2023, which only really led to just some sideways chop for the first couple of weeks. And so markets can consolidate either by marking time or by marking price. And at least in January, it chose to mark time. And so this is a similar situation where, again, from an overbought perspective, and for the NASDAQ from a mathematical Fibonacci type perspective, you have the market, which is really heavily run by one stock, which is NVIDIA, and you have a market that right now is extremely overbought with the potential for a potential pullback of size brewing. When you look at the Dow, you get a completely different picture because you just haven't seen the Dow really rally like the other indices, mostly because unlike the S&P and unlike the NASDAQ, the Dow doesn't have NVIDIA in it. And you can see that the 20-day moving average has been serving as resistance. The Dow is just not overbought. It's not oversold. It's just right in the middle of things. And so what that means is we need to really be careful, because it's possible that you could actually see something like the Dow rally despite maybe weakness in the S&P and in the NASDAQ, because you could see people moving out of NVIDIA, and that in itself would be a reason enough for those indices to go down. So I would be watching the Dow at 38,990 with a potential break of it moving up to the upper Bollinger Band here around 39.6. While another failure or push lower would probably lead us to testing this lower band at 38,000 or so. When we move over to oil is really interesting to watch right now because oil's been showing signs of breaking out. You can see oil has broken out. It broke this major downtrend. You can also see that oil is rebounding off of an oversold RSI. You can see that oil isn't really even overbought yet. What you're really talking about here is the potential for oil to get back up to around $84 to $85 now that this downtrend is broken, and also now that you've seen this resistance level right here around 80 broken. So I would be looking for higher prices in oil. And then finally, like we talked about copper, we were going to touch on that. Copper prices have basically finally gotten to about oversold levels, at least on the Bollinger Band. We've seen that that's acted as support. We're still not oversold on the RSI, But really, more importantly, you're still holding on to this 440 area, which has been of some importance. So we'll keep an eye on the 440 area. Obviously, a break of 440 opens the door down to 421 with the potential to go all the way back to 408. But as long as this 440 region holds and you start getting a turn higher in momentum, that would probably lead me to believe that we could see the copper prices actually begin to move back up again and potentially move over to these Bollinger Bands, which are likely to start contracting a little bit and move back up into this 460 to 480 area. Anyway, I hope you found this helpful, and we'll see you again next week. Bye.